In today's video, we're covering 0 DTE SPX options. Seems to be a real hot topic these days, and I think people are thinking there's some silver bullet and this is going to make them rich. Well, I'm here to tell you, hold your horses. There's no silver bullet. However, there is a way that we can use 0 DTE SPX options to make a quick profit and also hedge our portfolios. I'm Darren, and hey, I'm excited about this video. Many of you have been asking me what's the best way to trade 0 DTE options. Say no more. We're going to cover that in this video. We will discuss why trade SPX, what is the best strategy for trading 0 DTE SPX, and how do we place a 0 DTE SPX option trade, showing a real example on the option trading platform. For me, it's super important that we're using the safest ways to trade options while putting ourselves in the position to profit and make money as quickly as possible and grow our accounts. So if you're ready, go ahead and hit that like button and be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Why trade SPX? There are several reasons that SPX can be considered a good trading vehicle for shorter term options. First, it is extremely liquid. In other words, you don't give up a lot in the difference between the bid and the ask spread. This is because a lot of people trade it, so it's a high volume index. At the making of this video, the SPX is in the 4,300 range and the bid-ask spreads are 10 cents wide, so it is pretty fair and narrow. SPX is also cash settled. What does cash settled mean? A cash settled option is a type of option for which actual physical delivery of the underlying asset is not required. Instead, the settlement results in a cash payment. SPX is also tax advantaged. Now, I'm not providing tax advice, so talk with your CPA for that. However, it's my understanding that the SPX options are taxed at the lower long-term capital gains rate, which is an advantage for you at the end of the year when Uncle Sam comes knocking. These are three great reasons to use SPX if you're looking to trade 0 DTE options. What is the best strategy for trading 0 DTE options? There are different thoughts on this, and I'm sure there are multiple strategies that can be profitable. So I'm going to share with you what I'm doing. Please share in the comments below and let me know what you're doing that may or may not be working for you. If you've watched a lot of my other videos, you probably have noticed that I generally like to sell options rather than buy them. This is because as an option seller, we have a much higher probability of winning versus buying options. Really, the only time that I like to buy options is when I'm buying leaps options that are 1 to 2 years out to expiration. This way, I don't get eaten up by the time value just ticking away. So, with 0 DTE SPX options, why would I do any different? Time value is moving much faster, so that is why I sell credit spreads at the money. If I can make a quick profit, I then take it and look to rinse and repeat and do it again. If the SPX price does move against me, then I close and roll out and look to collect additional premium by widening the strikes. I like to do this as a hedge against the rest of my portfolio as a way to keep my deltas fairly neutral and in line. The market is not going to move straight up and it won't move straight down. It always moves in increments up and down. I do like to have trades on both sides, and SPX is basically my short side most of the time. So that is the general concept and the way that I like to trade SPX. How do we place a 0 DTE SPX option trade? Open up your Tastytrade account or whichever broker platform you are using. Tastytrade is one of the best and most intuitive for trading options. Please use my link below. And right now you can get cash back when you open an account depending on how much you fund your account with. I recommend at least a couple $1,000s so that you can place several trades. Now, if we punch in SPX in the upper left and go to the trade page, we can see the daily option chains. Notice the W for weeklies, which trade from 8:30 a.m. to 3:15 Central Time. Now take a look at the July 21st chain and the AM next to it. I stay away from these. This is the monthly SPX options, and they stop trading on the Thursday prior to the third Friday of every month. So they actually stop trading when the market opens on Friday morning and you're stuck and cannot trade them. And Thursday at the close is the last time that you can trade them. I found this out the hard way. So let's open up the 0 DTE SPX chain. SPX is trading at 43.67, so I'm going to go right at the money and sell the 43.65, 43.70 call credit spread. We click the bid to sell the 43.65 and the ask to buy the 43.70 options. And we collect $250 upon placing the trade, and the width of the spread is $5, so the max we can lose is the $5 minus the $250 or $250 as well. So it's basically a coin flip. We can make $250 or lose $250. We switch to the curve mode and see that we make the $250 as long as SPX stays below the 43.65 short strike price by the end of the day. So if this trade goes against me, meaning the SPX goes up above the 43.65 short strike, I will just roll out in time and collect additional premium. I know that eventually the market will have a down day and I will make money back and collect more premium. Here you can see where on June 15 I placed a $5 wide call credit spread and collected $250. The SPX stock price moved up and went against me, so I rolled to the next day, June 16, and doubled the width to a $10 spread and collected another $115. So now I had $365 collected on a $10 spread, so I had $635 in risk that I could lose. Now the market could keep going up and against me, and I can continue to lose, which of course it did. However, since I'm still delta positive overall in my portfolio, I will still make money as the market moves up on my other trades. So when it moved up, I closed out of the 0 DTE. However, this time I had to roll further out in time and also to $15 wide to still collect premium. We're now at the 44.05, 44.20 call spread. I only collected $50, so I'm now $685 collected on a $15 wide spread. So it's $1,500 minus $685 equals $815 at risk. You can see how you could get in trouble if the stock price just keeps heading to the moon. Now, as you can see, SPX has now finally moved down below my short call strike. There are 7 days left in the trade. I could close now and take the winner. However, that will leave me pretty long delta in my portfolio. I actually need the minus 86 short deltas to protect against a further drop in the market. I'm actually 60 positive deltas long overall in the portfolio, even with the 86 short deltas. So this is about where I want to be, since over time the market will move up at about an average of 10% per year, some years more, some years less. If we look at the longer term chart, I think we may still be a little overpriced. PEs are near 20, so they're high when they should be closer to around 15, which is typically a good price to get in at. So this is another reason I like to use an at-the-money call spread in SPX as opposed to an at-the-money put spread. And I need the negative beta-weighted deltas to oppose my long delta stocks that I really like now in my portfolio. All right, guys, 6 days to expiration, and the market is down this morning. I'm taking off the risk and banking the profit. You can see here I closed out for $240 debit. You can also see where we made $650 in the past 60 days. So this strategy is working for me right now, since I have been implementing it just fairly recently. Now I will look to put on the 0 DTE SPX call credit spread again, but just $5 wide, preferably on an up day at the start of next week. So I'll get back to risking just the $250 to make a quick $250. If it goes against me, then I roll, collect a credit, and rinse and repeat. So in following this strategy, we are still selling premium versus buying, so the math and theta decay is still in our favor. We are also evening out our deltas. We're banking winners and rolling out losers. SPX is liquid, cash settled, and tax friendly, So it's a good trading vehicle for this strategy. We can take quick profits if they're there, and if not, roll for credits and profit later. All right, guys, if you're a beginner and this sounded kind of confusing, don't worry. It did for me as well at first. We will continue to cover many detailed option trading tips and tricks in future videos, and we will continue to learn and succeed together. I've put a link down below for the free options workshop. Remember to grab that. Be sure and share the video with a friend. Leave a comment and let me know what you'd like to see in future videos. If you have any questions, let me know and I will be sure and answer them. All right, thanks for watching and see you in the next one.